certainly on LMAX exchange, liquidity is better this year. We have more banks, more non-bank liquidity providers than ever. We have much better scanning liquidity than we did this time last year. I think, look, the answer is in the question. When is liquidity not liquidity? When it's just an indicative price quote. And that's all the re-vended last look liquidity pools you see around the place. So, we have unique, firm, limit order liquidity. As we add more banks, as we add more non-banks, we have more liquidity. It's as simple as that, and I think that's the way the market's going to go. Perceived liquidity, phantom liquidity, will disappear in a heartbeat, especially when people are asked to use last look symmetrically. But I think firm limit order liquidity will increase. Look, it's about the cost of trading, so I would argue that firm liquidity will always appear wider than last look liquidity. So if you just judge the spread you see, then you're going to think you're going to pay a higher price. But actually, you do your transaction cost analysis, and you look at your fill rates and your slippage that may or may not be symmetrical on other venues, then the cost of trading is actually lower with firm liquidity. So, but, for the LPs, I think it is important that there's enough room for them to profit. I mean, with all the rules the regulators have put in over the years, the Volcker rule, market making used to entail taking some risk. Now, they're not allowed to take risk. And customers don't want to pay for liquidity or don't want to pay for execution. So why would you make a price? If you're asked to quote 0.2, 0.3, you can't run risk against it, and customers aren't paying for execution. So I think there has to be a balance. I think that balance will come in marginally wider spreads with firm liquidity, allowing the liquidity providers the ability to profit. But I think the regulators need to also allow market makers to run some risk. Otherwise, there'll be no liquidity, and let's face it, international trades needs an efficient FX market. No, it's nonsense. And that's nonsense propagated by the apologists for last look in the market.
What's your opinion?
Absolutely. Have a guess. The good news is it hasn't changed for 5 years. We've never had a last look on the platform, and we have more liquidity than ever. But look, Yakov, believe it or not, probably for the first time in 5 years, is right. It was developed for the right reason. And also, I don't think that everyone's abusing it. One bank's been found guilty of abusing it. But look, the simplest thing for everyone is get rid of the practice which is open to abuse. Because somebody will abuse it. And it tarnishes the name of the industry. It erodes trust from the customer. And ultimately, it affects our own industry. We've proven we have 25 of the world's largest banks providing firm limit order liquidity today. 9 of the world's largest non-banks providing only firm limit order liquidity today. They can price without last look. They can be profitable without last look. So let's just rid the market of it. If this standardization people talk about ends up, asking for symmetrical use of last look, it becomes irrelevant. It just means that customers get filled even less frequently, even when it's in their favor. That's what's going to happen, because the tolerance bands will mean you have to reject many more trades. So let's rid the market of it.
I think that
in some cases, customers haven't made a choice. In fact, 22% of institutional participants in our latest Restoring Trust in the Markets report said they weren't aware of last look. 85% said it was the practice most open to abuse. So customers across the realm of FX have not made that choice. Is the question, are they more important than 5 years ago? Sure. Do they have more market share than 5 years ago? Sure. Is there a good mix? Yeah. If you look at LMAX exchange, we probably have a mix of, it's now probably 50-50. Maybe that's changed from 55-45 in favor of banks a year ago. They're both important. I think the banks will, ultimately, they have real customer flow, so ultimately liquidity will always start there, but And I think the non-banks were perhaps more agile in their technology evolution, able to provide liquidity to more venues more quickly, and adapt to the sort of HFT trading environment. But the banks that I can see are catching up quickly. So I think the mix is here to stay. Hard to draw the link, if I'm honest, but no, definitely credit's more difficult to come by. So, that's why guys like ourselves are offering prime services, and it sort of came as a thunderbolt to a lot of buy-side customers when some of the normal PBs came along and said your balance sheet has to be X or Y, and literally people couldn't trade the next day or 2 weeks later. So that made it difficult, that stalled the market a bit. I think it's starting to shake out. And again, we have more clearing arrangements than we've ever had. Just more credit than we've ever had. And we have more clients looking to access that credit as well. But certainly it's still, I think, the main buy-side, a lot of the buy-side business in the first half of this year. And I think it will sort its own way out. Again, back to the points the guys made earlier on the cost of trading. I think part of it was PB was too cheap. It was too hard for these prime brokers to take all that credit risk and not get paid for it. And guess what? They'd worked or serviced the customer for 2-3 years, and then they lost it all in 10 minutes on the 15th of January. That's not good risk reward. So again, if you need credit, you're going to have to pay for it. Look, I've got to disagree with the rest of the panel. I think spreads are already wider. The artificial spreads, the indicative price quotes may not be, but spreads are a bit wider. And I think you wrote an article actually that I read on the way here that said one of the primaries had blown up by half a tick in 20 bucks. So, and that was in a major currency pair. I think they are wider, but it'll happen incrementally over times.
Would you be able to maybe put an estimate of how much wider you think they are at the moment?
It's tough. You look at it, that's why spreads are probably so tight that if you don't care about a quarter of a tick or half a tick, then they're not wider at all. They're probably 0.1 wider over the last half year, I'd say, in majors, 0.1, 0.2, depending on the time of the day. You'd probably be more aware of that than I would, but certainly around the number, I think they're a lot wider. And there you're talking, maybe a tick wider. But they were probably too tight over those numbers last year. 2016 is going to be great. The Swiss have no peg to remove. The working groups will keep talking and talking and talking and talking, but there will be more firm liquidity on LMAX exchange with firm, fast, free market data.